In the quiet, fluorescent-lit corridors of the Federal Reserve Bank of New York, something extraordinary unfolds every night. Trillions of dollars move in and out of a financial mechanism that almost no one outside Wall Street has ever heard of. No, it's not a conspiracy, not a secret vault filled with gold bars. It's something far stranger, far more powerful, a machine called the Reverse Repo facility. It's a name so obscure that even seasoned bankers sometimes struggle to explain it. Yet, behind this dull label lies one of the most influential levers in global finance. A system quietly holding more than $2 trillion of idle cash. Trillions that shape interest rates, liquidity, and the flow of money around the world without most of us ever realizing it. To understand how we got here, you first need to decode the system that gave birth to it, the repo market, short for repurchase agreements. This is the invisible engine that keeps the global financial machine running. Think of it like a pawn shop for banks and money market funds. Institutions lend each other cash overnight, using U.S. Treasuries as collateral. The next day, the borrower repurchases those securities at a slightly higher price. That tiny difference, mere fractions of a percent, is the interest earned. This cycle happens daily, unseen by the public, but it's essential. It's what keeps banks liquid, interest rates stable, and markets alive. But what happens when the balance breaks? When there's too much money chasing too few borrowers? That's when the reverse repo facility steps in. In a reverse repo, the roles flip. The Federal Reserve borrows cash from private institutions, pension funds, mutual funds, foreign central banks, and lends them treasuries as collateral. The Fed pays a small interest rate, known as the RRP rate, to these lenders. On the surface, it sounds harmless, a safe, temporary place to park cash. But beneath that calm logic lies a warning sign. By 2023, this quiet corner of the Fed's balance sheet had ballooned to over $2 trillion, money essentially parked, earning interest but doing nothing for the real economy. It was supposed to be a pressure valve. Instead, it became a black hole, a daily ritual of trillions moving in and out. Not to build, not to invest, but to hide debt. To understand why this happened, you have to go back to the chaos of 2020. When the pandemic struck, the Federal Reserve unleashed a historic wave of quantitative easing, printing money to buy bonds, mortgage-backed securities, and treasuries. It was meant to save the economy, and in a way, it did. But it also created an unintended side effect, a flood of liquidity so vast that the system began to drown in its own cash. Banks and money market funds suddenly found themselves sitting on oceans of idle dollars. Yields on short-term treasuries dropped near zero, in some cases even negative after inflation. With nowhere safe to park this tidal wave of money, the Fed's reverse repo facility became the ultimate shelter. And so began one of the strangest transformations in modern monetary history. A mechanism designed as a short-term stabilizer turned into a long-term dependency. By mid-2023, nearly every major money market fund in America was using it. Pension funds, foreign central banks, mutual funds, even corporate treasuries. What was once an emergency tool had become a permanent parking lot for the world's excess cash. But there's a problem with safety. It feels good until everyone wants it at the same time. When trillions of dollars sit idle inside the Fed's vault, they don't circulate through the economy. They're frozen, locked liquidity that can't fund businesses, build homes, or create jobs. It's as if someone drained $1 trillion from the bloodstream of global finance and sealed it in a vault under Manhattan. And while that money sleeps, the rest of the system grows brittle. Lending slows. Risk-taking disappears. Bond markets lose momentum. The Treasury, once the safest borrower in the world, starts struggling to find consistent buyers. The machine that used to hum begins to stutter. Economists have a name for this: the reverse repo trap. It's the financial equivalent of an engine flooded with fuel. Too much of a good thing choking the system from within. The Fed, once the lender of last resort, had become the borrower of first choice. The irony? In trying to keep the economy stable, it may have built the very imbalance that threatens to destabilize it. But that's only half the story, because beneath the numbers lies something deeper, something psychological. The reverse repo facility isn't just a technical instrument. It's a mirror of fear. Fear of risk, fear of loss, fear of what happens when trust in the system runs out. And in the world of modern finance, fear spreads faster than any virus. When money stops moving, the economy starts to freeze. And that's exactly what began happening. Every night, trillions flowed into the Fed's reverse repo window. Every morning, it flowed back out. The cycle looked stable, but underneath, it was draining life from the markets. Liquidity, the invisible blood of the financial system, was being hoarded instead of used. Banks, already cautious after years of regulation and sudden bank failures, pulled back even further. Lending slowed. Risk-taking collapsed. The system was safe, but paralyzed. And the irony deepened. The Fed, while paying billions in interest on this parked cash, was also raising rates faster than at any point in 40 years to fight inflation. That meant the more money it absorbed, the more it had to pay out. In 2023, the Federal Reserve recorded its first negative income in decades, a quiet milestone that few noticed. The central bank designed to create money was now losing it. But beyond the accounting lies the psychology. The reverse repo facility had become an addiction. Financial institutions no longer saw it as an emergency tool. They saw it as a guarantee. Why lend to a small business or buy bonds when you could park your money at the Fed and earn a risk-free return? The result was invisible stagnation, a silent tightening of credit that didn't appear in headlines but crept into daily life. Small businesses struggled to borrow. Housing loans slowed. Markets grew thinner. And the more the Fed tried to control liquidity, the more fragile that control became. Because in the end, this isn't just about interest rates or balance sheets. It's about trust and what happens when the most powerful institution in the world becomes both the safe haven and the source of fear. Every financial system depends on balance. Borrowers and lenders, risk and reward, motion and restraint. But the Fed's reverse repo system had upset that equilibrium. It was supposed to stabilize markets. Instead, it began competing with them. Here's the paradox. The more institutions parked their cash with the Fed, the less they participated in the real economy. And the more the Fed paid to hold that cash, the more dependent those institutions became. The mechanism designed to prevent crises was quietly breeding the next one. This isn't theoretical. Each night the Fed borrows trillions from private institutions, money that could be funding innovation, factories, or mortgages, at an average interest rate of around 5%. That's over $100 billion a year flowing from taxpayers to Wall Street's safest hands. BlackRock, Vanguard, and JP Morgan's funds, the central bank meant to support the government's borrowing, is now competing with it, both chasing the same pool of investors. When the Fed's rates become too attractive, investors stop buying U.S. Treasuries and choose the Fed instead. The result? Weaker Treasury auctions, rising borrowing costs, and an increasingly distorted market. One arm of the government quietly cannibalizing another. This feedback loop is what economists now call the reverse repo trap. Every decision the Fed makes raising rates, cutting them, tightening, or easing reverberates through this trillion-dollar system. Move too fast, and liquidity floods the markets, sending interest rates crashing. Move too slow, and cash stagnates, starving credit creation. Either way, the Fed loses control of the machine it built. And yet, outside the walls of the New York Fed, few people even know this system exists. No press conferences, no headlines, just quiet numbers buried deep in the Fed's balance sheet, quietly steering the global flow of capital. But those numbers have consequences. Mortgage rates rise, corporate credit tightens, pensions wobble. A hidden lever in the basement of the world's most powerful bank is quietly shaping the fate of every household, every paycheck, every investment. Because at its core, the reverse repo isn't just about money. It's about fear of lending, fear of loss, fear of another 2008. And when fear becomes the foundation of finance, stability turns to illusion in the end. The greatest danger isn't the trillions parked in the Fed's vault. It's what happens when that money moves. Because one day, it will. The reverse repo system isn't a vault, it's a dam. Behind it sits a reservoir of liquidity, calm on the surface but heavy with pressure. When rates change, when trust shifts, or when opportunity outside the Fed becomes more attractive. That money won't just trickle out, it will surge. If even a fraction of those trillions suddenly flow back into Treasury bills or private markets, the shift could jolt the entire financial ecosystem. Interest rates could whiplash. Credit markets could seize. The same tool that once absorbed excess liquidity could unleash it in a violent flood. It's not theory, it's history repeating itself. We saw the preview in 2019, when overnight lending rates spiked from 2% to 10% in a single day. The cause? Too little liquidity in the wrong place at the wrong time. Now imagine that on a scale 10 times larger. The Fed calls it management. But the truth is, the system has become too interconnected, too sensitive, too fast for even the Fed to control. Every move ripples through global markets from London to Tokyo to New York, altering currency flows, bond yields, and confidence itself. One small miscalculation could trigger consequences no model can predict. And beneath all the complexity lies a simple truth. Money has stopped being a tool of exchange. It's become a weapon of policy. The reverse repo facility is proof of that, a mechanism that freezes capital, rewards inaction, and quietly transfers wealth upward. It doesn't build, it pauses, it hoards, and in that stillness, opportunity dies for ordinary people. This imbalance shows up in small ways that don't feel small. A mortgage rate that jumps overnight, a job offer that vanishes, a retirement fund that suddenly loses value. The plumbing of the system feels distant until the water stops flowing. The modern economy runs not on gold or paper, but on trust. And when trust becomes centralized, when it depends on one institution's perfect execution, that's not stability. That's fragility disguised as order. Because no system built on control can outlast the chaos it tries to contain. The reverse repo facility isn't just a technical feature of the Fed's balance sheet. It's a mirror reflecting our entire era of finance, an age that mistakes intervention for wisdom and stability for safety. And when the music of this delicate choreography finally stops, it won't be chaos by surprise. It will be the inevitable silence of a system that forgot how to dance.